Good morning. You're watching the market right here in ET now, while we are still grappling with a very unseasonal weather pattern here in Mumbai, and it was pouring yesterday, wasn't it? It felt like we were in the peak of monsoon.
Pouring yesterday, pouring last night, and pouring in the morning.
Yeah, this morning too.
You know, now I am officially saying rain will go away.
Yeah, because
just
with that, I mean, people are falling sick as well because of
Climate
this,
change,
one day
change.
extreme heat and the other day.
Usually during
rains.
Ganesh, we do see Ganesh Chaturthi, there is rain, but this has perhaps been extended even longer than that.
I think rain started less, so you got to grant it to, you got to look at it logically that the entire cycle is going to perhaps elongate itself till end of September, maybe first week of October. But yeah, it's unusual to see that it's not raining, but it's pouring. It's a downpour, not just, passing showers.
Passing shower. Okay, but passing showers, not quite. It's a downpour of gains across the markets and globally, not just us. The S&P 500 index, the Dow Jones, they are all closing in at life highs. US futures, of course, this morning are pretty steady after that winning session that they had overnight. And Asia as well. The fact that PBOC has announced slew of policy easing measures in a very rare briefing, that's really sent the Chinese and the Hong Kong markets in a tizzy. Hong Kong holding up 350 points nearabouts right now in trade, and Shanghai scaling higher by roughly about 1% as well. Japan too going good, about almost a 300-point rally there as well. In the meantime, of course, China is also going to be cutting the RRRs by about almost 50 basis points. That's the word coming in from the PBOC governor. So it seems like from the far west to the far east, the rate cut cycle has begun. Now, of course, all eyes are going to be on India. But for the global equity markets, the construct looks quite healthy right now.
So Aisha, the so-called rate cut rally has extended itself. Things are looking stable. I'm just purely talking about the global setup here. Same time last week, markets were confused about implications of the rate cut in the short term, but I think that's passé now. Now things are looking up. S&P and Dow, they both have closed at an all-time high. Commodities got crushed, and the interesting bit for me is that it's no longer only Nasdaq or the Magnificent Seven which are driving the US markets, which means the breadth in the US market is improving. Rate cut sensitives, all the other sectors are kicking in. So if one has to really look at the construct of the global market, which is what we'll just do, and we'll talk about India and other things, I think the global markets are looking stable. The rate cut narrative is strong. Two interesting things here. Number one, despite all this China rate cut indication and despite interest rates going down, that has not translated into a bumper rally for commodities, which historically it has. One. Second, China is talking about increasing liquidity, and metal stocks are just doing nothing. So this entire China connection with commodities and the world China and the effect that China could have progressively in demand and in terms of impact on inflation, I think that has become passé now. So frankly, if you ask me that if I have to connect the dots here, the departure between last time and this time is that anything which has got to do with China connection, I think is not really having an impact, negative as well as positive. Imagine China cutting rates. They're fusing liquidity. 3-4 years ago, metal stocks would have gone through the roof. Chinese stocks would have come back. So right now, markets are saying, okay, China is important, China is crucial, but it is not relevant in the near term, at least for financial markets and more importantly, for commodities. That is my take.
Okay, that's how one should be reading into the overall global cues as well as all that's going on within the world of commodities. But for our own markets, it was a downpour of gains, if you will. Yes, indeed, we held out quite comfortably in the green, 25,950. We notched that level for the first time, only to wrap up comfortably close to that mark, just a smidge below. The broader markets as well held out in the green, and you did have contribution coming in this time around from the financial space. It was actually all sectoral indices that did manage to gain. So barring IT, which was in a bit of a rough spot, most of your sectors were holding out in the green, with PSU banks actually as the top gainers. So you did continue to see that FII buying figure as well kick in. So post the Fed rate cut, we have been seeing, Nikunj, robust FII flows, and it's life highs on D Street. One just wonders whether this exuberance is rational and going to last.
Okay, why are markets going higher? I think large part of that I think is a pure function of liquidity. We know that, but this time liquidity is coming from a different source. And in this, we would love to take the credit and say that we told you so, that when Fed rate cut will start, foreign institutional investors will come back. And boy, they are back. Let's look at that data. We are looking at, and September is not finished, we are looking at $5 billion of cash market inflows. Now that is a historic number. Look at Philippines right at the end of the column and look at India. Compare that with Indonesia and look at where Thailand stacks up. The flows into India are double that of Indonesia, and money is just not going to any other emerging market. So the flows into India, both in terms of quality and also in terms of proportion, I think is extraordinary. Why that is happening? I think it is moving as per the script, which is that Fed has cut rates, money is coming back into emerging markets, and this time around foreign institutional investors are really suffering with what really could be called as the FOMO effect. We've been talking about FOMO by retail, FOMO happening in the IPO market, but the data is indicating, and this is data from Bloomberg, Sumit's data, which is that there is definitely an evidence of FOMO by foreign institutional investors, and they are coming back. Now let's assume that if this FOMO effect continues, what will happen? Because this kind of inflow is not going to reverse. For the longest time, FIIs were shy. They were finding India expensive, they were worried about election outcome, they were worried about budget, but they've come back and it is coinciding with a rate cut. So if these flows are real and this FOMO effect will continue, I guess you will see outperformance in large cap stocks. You will definitely see outperformance in banks. And the differentiating part, Aisha, here is that foreign institutional investors are not exactly buying the same names which they bought earlier. For example, they are now buying into tourism, they are now buying into hospitality, they are buying into hotel stocks, they are hospital stocks, they are buying into niche consumption pockets, they are buying into machinery stocks. So FIs are back, Nifty will outperform. You definitely will see an element of very little selling. FI is not selling, DI is not selling, retail is not selling. So selling is not going to be there. But the profile of stocks which historically have gone up when FIs have bought versus now, I think that should change.
Yeah, absolutely. Though to be fair, yesterday it was the DIIs which actually led the charge. You had a very small buy figure coming in from the FIIs. But the interesting thing is SEBI has revealed another study, much like the IPO investors case study that they brought about with, and they are saying that 93% of individual F&O traders made losses between FY 22 to 24. Now, this of course assumes extremely high significance because the earlier study published in January 2023 by the capital market regulator also showed that 89% of individual equity F&O traders did lose money in FY 22. So irrespective of the bull market at play, and a roaring one at that, it's not been the same for F&O traders.
So Aisha, this SEBI data is more like an eye-opener, and this SEBI data is perhaps a clear indicator of how the odds are stacked up if you're trading in the F&O market. The F&O market has seen an extraordinary participation by retail investors. Post-COVID, the number of demat accounts, the activity in the F&O market, the ease with which you can trade has only increased. Now the F&O transactions, and here's the data, that 93% plus F&O transactions were done by retail investors, I think are at a loss. The point perhaps SEBI is trying to say here is that if you're trading, the odds are not in your favor. And when odds are not in your favor, then why go and attempt something where you know that you have a strong chance of losing money. Now, trading may give you instant gratification, but ultimately, if you're losing money, that will have an impact on your savings, and that will have an impact on the way how you essentially would be investing in future. I've always believed that for India, the story is long-term investment, and the bedrock or the backbone of this market is DI flows, which is coming by the SIP route. And that is the reason why this market in a sense is standing where it is, largely because of DI participation. The problem with this F&O trade is that it looks great, but if losses and if odds are not in your favor, this is something which is going to leave a lot of bitter aftertaste, and it will have an impact. The losses of this total combined F&O trading, according to SEBI, they've gone to about 1.8 lakh crore. Imagine the systemic risk which could happen because of this F&O trading, because somebody will have to bear the loss. And that loss, if it is on somebody's balance sheet, either they will have to plunge into their savings or they will have to borrow money to pay it, and then I think that is becoming a systemic risk. So I think SEBI is trying to, I would not use the word warn, but I would like to use the word raise a red flag, that when odds are not in your favor, why go on that? Second, there's systemic risk which could come in, and which is where regulators and other lenders, they really need to watch out for. But the data when is there in front of you. My point is, why walk on a treacherous path?
Yeah.
I mean, it's even worse than, in FNO trading, the odds are even worse than when you're going and playing blackjack in a casino. There you have 50% probability
Where
of
the house is
getting it
supposed
right.
to win always.
Exactly. So in this case also, the participants are not making money. 93%.
1.1 crore traders, they've lost 1.8 lakh crores in 3 years.
Yeah.
Yeah,
1.8 lakh crores.
1% of individual traders have actually earned profits exceeding £1 lakh. So that's...
So it's instant gratification, right? Instant gratification looks very great, very nice. But this is not the way how wealth has got created. And what is the story of India? Domestic institutional investors are buying, money is coming via the SIP route. It's such a beautiful story on which Indian equity markets are standing tall. This is the bad part of a bull market when participation goes. But again, we go back to that same data. Folks, please. 93% of the trades, and this is data which is coming from SEBI, they've lost money. So why attempt?
Yeah, see, a marketplace is made by all kinds of participants. The fact that this kind of a tool of options trading is there, I don't think they're against that. It's about the addiction that one gets into. That is what they're warning you against.
See, if you have invested in SIP, especially equity markets, and the holding period is more than 5 years, the chances of losing money in any cycle is less than 30%. If you've been holding on to stocks for more than 10 years, your chances of losing money in a cycle is 0%. Until unless you really look at the COVID as the marking point and all.
One-off event.
So again, we go back to that same point, which is that the toolkit, the options are there. FNO market is there. It is available. There is there's nobody preventing you from doing it. But this is the market where you perhaps should not chance your arm. Why? Because this is a very sophisticated market.
Don't dip into your savings and start deploying that money here.
Yeah, and then when markets go volatile, which is what it happened, let's say on the election day, big swing. Budget day, big swing. What happened on the yen carry day, debacle, big swing. That day, if you are in the options market, it is...
You're burning your fingers.
You actually may just burn up your entire capital because the swing is that high.
Yeah, right. Absolutely.
If you like this video, then like, share and subscribe to ET Now.